Vaughan. Rushanara.
Thank you very much. I've got some questions on the consumer insurance market and also on competitiveness of banks, savings and mortgage products. And I don't have very long, so I would really appreciate prompt, swift answers. So the recent Dear CEO letter to general insurers noted that under the duty we expect senior managers to ensure customers are at the centre of the claims process, and we encourage firms to review their product procedures to make sure they mitigate the risk of poor practice and customer harm. Have you done much work to assess how that is being conducted, and what kind of customer harm is taking place in the insurance market?
I'll talk about three things. Firstly, we have put in place specific proposals around general insurance pricing practices to tackle the loyalty penalty, an issue that Citizens Advice and other consumer groups have drawn our attention to. Those are now embedded, and we believe that, broadly speaking, they're starting to make a difference. But it's early days, and obviously there's been a lot of volatility in the supply chain in the last year. Secondly, we put out a warning alongside the Dear CEO letter a few months ago, warning about claims, particularly motor insurance claims, where we felt insurers were not paying the fair value of the claim. And we have warned insurers that used car prices have gone up, and therefore when they're settling those claims, we expect them to be paying fair value to the claimants. The third issue, which you talk about in terms of claims handling, thank you for raising that. There is an issue here in relation to the outsourcing of claims handling, where an insurance firm may outsource it to a third-party insurer or another claims handling firm, and that can provide benefits in terms of efficiency. It may provide benefits to the firm, but sometimes, as you point out, consumers may not be getting the service they need. This is exactly the kind of issue where we think the new consumer duty will help us, because we have told everybody, and there are some good practices from insurers, that they need to be thinking about the entire chain. They can't simply say that they are outsourcing and then their responsibility for dealing with a claim will no longer persist, including in relation to disputes being sorted out at the Financial Ombudsman Service. So this is very much on our radar, and we think through the new consumer duty, which is being implemented now, we will have very strong tools to deal with those practices.
Could you write to us to let us know what the pattern is in terms of these outsourcing practices and what you're finding? Because I know from direct experience as well as experiences of constituents that it can take months, and I wonder whether there's an incentive structure, I don't know, that's been built in with outsourced companies that is leading them to treat customers badly, and that's causing serious detriment. Would you be able to do that?
I'll be pleased to write to you. And one of the limbs of the new consumer duty is customer service. And how are firms, when they're selling products and distributing products, thinking not just about the initial product, but the customer service they provide through the journey? And that's a key component for us to look at.
Do you have any proposals to deal with, I mean, in some cases, 2 or 3 different sort of outsourced companies that are involved, you know, from the broker that one might get insurance from to the payment, the company that does the payments and the companies that do loss adjustments and so on. You've got multiple groups involved. Do you have any sense of what is the mechanism for making sure that the senior managers, and you've got in one of the letters, I understand that that was something that was raised about the responsibility of the insurance company to really track what's happening in terms of the chain that they're using. I don't believe that's happening effectively. Do you have any insights into what's going on in terms of implementation? Because I'm anecdotally aware of some very poor practice, which can lead people to spending a lot of money on legal action and actually causing a lot of harm.
I wouldn't say we have specific proposals, but what I would say is that there are examples of best practice. And I won't name the insurers, but there are one or two insurers.
The point I'm making is, with respect, I'm interested in bad practice, because that's what we need to sort out. Good practice is great.
The point I'm making is there's an example of some very good practice from some insurers. Through the new consumer duty, we want to raise everybody's standards to the examples of best practice, where if you buy an insurance product from a car insurance provider, they take ownership for that relationship with you. not just at the point where they sell the product, but also when you make a claim or something else goes wrong. And that's where the new consumer duty, I think, will make a very significant difference to our ability to act.
We're talking about the consumer duty, but do you have a sense of what's been going on in that market in terms of the experience of consumers and where, I mean, you've alluded to some issues that you've already picked up, where there are, serious concerns that need to be rectified, and what can you do proactively? Obviously the letter helps, proactively to track and monitor and assess what they're actually doing.
We have written to the firms and we are collecting data.
Yep.
We also engage with the Financial Ombudsman Service, because one of the frustrating things for customers is when something goes wrong, particularly with some of these outsourced providers, they go to the Financial Ombudsman Service and they don't feel they can get their dispute resolved. And that's clearly a gap that needs to be sorted out. So those are things that we're doing already. What I'm saying to you is that in the coming months, our tools to deal with this will get further strengthened.
Would you be able to share with us the information that you're getting in terms of this work you're doing?
I have to cover that in our letter to you.
On financial ombudsman, as you know, we've been looking at this for many years, and there was an inquiry into their work, a major report. There is a big issue, and I've raised those issues about whether it's resourcing, where it can take months before a consumer makes a complaint, even if it's relatively straightforward, before they'll actually be able to resolve that particular complaint. It can take 2 to 3 months, sometimes a lot longer. That's not very satisfactory. Do you think there is an issue about the interface between these things, so the consumer experience is actually not a particularly good one, even if the outcome might be a positive one, because of the length of time these things can take?
Yeah, and I believe Ashley is going to be taking over the chairmanship of the Oversight Committee of the Financial Ombudsman Service, and I can't speak for them. I know that they have been working hard on their backlog, but the overall point you make is that when a dispute is raised, that, of course, one would want that to be resolved as speedily as possible. The work we're trying to do, as well as through our wider implications framework, working with the FOS to make sure we're as aligned as possible, what we're also trying to do is reduce the number of complaints that get to the FOS in the first place. And one of the points we've put in our strategy in terms of an outcome metric is to reduce those number of complaints, which is part of what we want to test in terms of new consumer duty, because of course that's the last resort. You much prefer the firms not to take action which results in a complaint, or to resolve the dispute themselves.
Okay, I mean, is there a case for financial penalties or some sort of penalty for companies who are behaving badly? I don't remember whether there are any.
So the Financial Ombudsman Service can award compensation. We will take up cases where we believe a firm is not responding appropriately to Financial Ombudsman Service rulings. We will take that up through supervision, and that would ultimately be a breach of our rules if they do that systematically.
The parties that are being used, some of them are acting like cowboy contractors. Is there a case for cleaning that up and actually penalising insurance companies that are using companies that are really not providing a good service to consumers?
I would agree that insurance companies need to take responsibility for the entire chain.
Do you think who should be doing that? Are you prepared to take action against insurance companies that are not really taking due care in the companies that they're contracting to settle cases and so on?
Yes, we will. And I've said the new consumer duty will help us in that. And I think our track record of taking action on insurance issues when we've needed to, both in terms of business interruption, where we took a case to the Supreme Court, and the general insurance practice, I think we've got a strong track record of tackling those practices where we have the evidence to do so.
Thank you. I'm going to use up my final few minutes on the competitiveness of bank savings and mortgage rates. Obviously, this has come up quite a lot in terms of savings rates, for instance. Just on the major retail banks' financial results for 2020 shows increase in profits and net interest margin. What work, if any, has the FCA done to monitor whether retail banks are earning disproportionate profits through increasing the interest rate margin and increasing rates on mortgages far quicker than rates on savings products?
We are monitoring this. We're engaging with firms in terms of how they've been moving mortgage rates and savings rates. You will have seen that we wrote a letter to banks in February setting out our interest in this topic. And we do not set prices in markets, so we do not set savings rates, we do not set mortgage rates, but we do have an objective to make sure markets operate with competition in the interest of consumers. And the kinds of issues we are looking at and the fair value rules that are coming into force and the new consumer duty will mean banks have nowhere to hide on this. The kinds of issues we are looking at are in pricing decisions, are banks relying on customer inertia? We did some work a few years ago, and broadly speaking, 80% of savings products are back book off sale and 20% are front book on sale. Are they relying on lower pass-through for those that are back book for loyal customers? We want to understand how those decisions are being made. You rightly pointed out the speed with which decisions are made. Is there a governance process which is encouraging decisions on mortgages to be made faster than decisions on savings? And in some cases we have seen that. Where
So what are you going to do now to signal to banks? Because I think we need to use the powers. We need to make sure you use the powers that you've got, so that banks are fearful enough that as the regulator, and it's one for the new chairman as well, that they are going to take action. So that they're not being unfair in the way that they're applying interest rates on the one hand on mortgages and not passing on savings rates, increased saving rates in terms of savings.
We've already raised this specific issue with, in some cases, boards of banks. So it's firmly on their agenda. We expect them to be looking at it. We certainly don't want to be raising it repeatedly with them. So that has been pointed out to them.
Have you set them a timeline and what your
as I say, we do not set prices for these banking products.
No, I'm not talking about that. I'm talking about them taking you seriously as the regulator when you tell them that you're concerned about something, that they take action within a given period of time, because there have been issues about certain banks not taking seriously the regulator.
Can I just again from my perspective on this, I think it's obviously an extremely live issue and it is important. I think there is a question around the set of justifications. Are they credible or not for that differential? I think it's actually. It's a little bit more complicated than first meets the eye. But if one of the dynamics is taking advantage of customer inertia, and if that's a major dynamic, that is not acceptable.
It's a loyalty penalty, isn't it? Yeah.
Okay, so that's my own view. I think in relation to new consumer duty, that comes on stream effectively for new products in July. I know that the FCA, notwithstanding the fact that that comes on stream in July, has basically been engaging with firms, having that conversation right now around what the consumer duty actually means, and in particular the concept of fair value. So, once you're drilling into fair value, that's a very good, or it's a very useful hook to have those conversations.
We've also been supportive of steps to improve competition in this market. So we've been supportive of the open banking work and supporting challenger banks. So, for example,
so I just want to come on to that, because obviously we've got between 2018 and 2020, you've got the big four have increased their share of residential mortgage advances from 46% to 53%. We've got already, your work, I think it was last year, was very helpful in projecting that there could be 750,000 mortgage defaults. My understanding is that 200,000 mortgage holders are already in default, and there are real concerns given interest rate rises in terms of what the impact will be. We've also got a history of certain groups who are mortgage prisoners. We've got people who are stuck in mortgages despite the some work that's been done around EWS1 certificates, which we'd raised in the past. What's your overall assessment in this context around, on the one hand, banks are not, being quite there's sort of double standards in terms of quick to pass on mortgage rate increases on the one hand, but not in terms of saving rates. There's an inherent unfairness in what's going on. So what do you think you can do as the regulators to try and sort of use your powers to ensure that people don't face financial distress and banks behave appropriately and not abuse their powers and the fact that they are able to do what they're doing, which is not passing on rates to savers on the one hand and increasing quite quick to increase mortgage rates?
If I take the mortgage rate situation to start with, actually, since I was last before the committee, the situation has become somewhat more encouraging, as pressures on households remain significant, but they have eased somewhat since December, with energy prices coming down and also the employment market holding up somewhat more strongly than we feared might be the case a few months ago. So our latest figures would be approximately 356,000 consumers will be financially stretched by the end of June 2024, which is an adjustment down.
On the mortgages side.
On mortgages, adjustment down from where we were a few months ago because of just how fast these markets are moving. To clarify one point
Does that include the 200,000 in default?
That includes the 200,000. I wanted to clarify that. The 215,000 are in some degree of payment shortfall. That does not mean default. That means they're in some degree of payment shortfall. That's approximately 2% of the mortgages, and around 116,000 have arrears greater than 1.5% of their mortgage balance. We have been very proactive in terms of our engagement with banks to make sure they treat customers fairly, work through issues, encourage them to contact them early, give them multiple options where they are facing difficulties. And so far, broadly speaking, for the largest institutions, we're seeing them acting appropriately. The number of repossessions is at 1,054 in the most recent quarter where we have data, which remains significantly below where we were before the pandemic. There have been 32 institutions where we have felt they have not treated borrowers in financial difficulty appropriately, and we've intervened with those institutions to encourage them to remedy their conduct. So we are very alive to these issues, and we're watching them very closely indeed. And I believe the leadership of banks understand their reputations are at stake if they don't handle things appropriately in the coming months.
So would you be kind enough, Nikhil, to send us a follow-up letter to the one you sent us previously with those refreshed statistics, please?
Yeah, so we're going to be the statistics will be ready for publication in a week or so's time. After that, I'll be able to share those with you.
Thank you so much. Anthony.
Thank you, Chair. So I have two questions on two